Good morning or good afternoon to everyone joining. And wow, what a turnout there. It seems the Omnibus and EU regulations is definitely top of mind for many, as it has been for Agendi, especially in the last 48 hours. I'm Helena, Managing Partner at Agendi. I'm based in the London team. I've spent the last 2 decades working with global organizations on key sustainability topics, in particular climate strategies, risk, and increasingly regulations, which of course is the topic for today. I am joined by my 2 fabulous colleagues, Victoria and Capucine, both managers at Agendi, and they are both coming with a host of hands-on EU regulations experience to share with you all throughout this webinar. It's a pleasure to be here. We have around 45 minutes to provide a practical and strategic look on what the Omnibus proposal means for your organisation. Are you still in scope? Are you out of scope? What are the next steps of the approval process, and what are the risks? Before we begin, a quick note, we're recording the session. We'll share the content, so no need to take any frantic notes. We've got you covered. We've got a lot to cover, so let's get started. Before I begin, a very quick introduction to Agendi. We are a specialist climate sustainability strategic consulting firm. We have offices based in the US, UK, Europe, and we try to bring, well, we don't try, we definitely bring a practical and forward-looking approach to our clients. We work across all sectors with a focus on large global organizations, and we support companies across E, S, and G, including strategy, target setting, quantification, transition planning, and of course, compliance. Our approach is based on knowledge sharing, capacity building, and we always bring full transparency across all of our calculations, our models, and our deliverables. So one of our key areas of expertise and the focus of today's session is complying with sustainability disclosure requirements. So I think let's dive in. So today we are going to focus on the EU Omnibus proposal. What it is, what does it change, why does it matter? And then we're going to go into the impact of it. How might your reporting obligations evolve? If you fall out of scope, might be a sigh of relief, but we'll cover what's next for those companies. How can you adapt your strategies? And of course, those within scope, what to look out for, how may things change? Of course, as a reminder, at this stage, the Omnibus is just a proposal, although the general consensus is it's expected to pass, but we will be covering those risks and the associated process across the webinar. We have a Q&A box running. We encourage you to submit your questions. We'll do our best to come to the end. If not, we'll pop them in a dedicated follow-up. Rightio, I think we can begin. Before we deep dive into the regulations, I think it's important to first take a step back, look at the bigger picture. Whether regulated or not, sustainability has shifted from a nice to have to a material business requirement to mitigate risk. So if we break this slide down into 3 parts across the slide, what I've put on the left-hand side is the World Economic Forum and Global Risk Report from 2025. And we see over a 2-year horizon, extreme weather events ranking as the 2nd most significant global risk, only behind misinformation and disinformation. Over a 10-year horizon, climate risks dominate, and we see extreme weather, biodiversity loss, and critical changes to the Earth system ranking in the top 3. Now, this, of course, signals a major shift. Sustainability is no longer an isolated concern. It is a key driver of global instability, with direct financial, geopolitical, and social implications. So when we think about it from a business perspective, what does this mean? We see risk exposure growing. Climate, biodiversity, resource restraints are moving up on corporate risk registers. We think about stakeholders, including investors, regulators, they're paying more attention. So moving into the center of this slide, we have the latest IPCC emissions trajectory. And where are we now? Well, current policy pathways are not sufficient to limit warming below 1.5 degrees. So what we know is that we're headed towards 2 degrees or beyond. And that, of course, leaves a critical gap. We're going to need stronger emissions reductions, rapid policy shifts, behaviour change, and corporate action to limit that warming to 1.5 degrees. So what does this mean for companies? Well, regulatory pressure, it's going to continue to tighten. We're going to see climate disclosure, transition planning, the need for emissions reductions, and this is only going to accelerate. It will also mean financial risks will intensify. As we exceed key temperature thresholds, we will see supply chain disruptions, resource volatility, and cost pressures rising. So this is not just a future scenario, this is a now scenario. And finally, on the right, what I've popped in there is an image to show the cascading nature of climate risks. A key climate driver, extreme heat and drought, sets off a chain reaction of social, economic, and environmental consequences. And this reinforces a crucial message. Sustainability risks do not sit in isolation. They're interconnected and amplifying financial, social, and systemic instability. So as a business, ignoring sustainability risks is a financial liability, and businesses need proactive strategies for climate adaptation, risk mitigation, and overall resiliency. And as we consider what this means for companies, we need to think about what those direct financial consequences may be. So this translates into 4 core business impacts: reduced revenue overall, increased capital costs, higher operating costs from climate change, adaptation, regulatory compliance, supply chain volatility, as I mentioned earlier, and rising financial costs overall, as sustainability risk becomes a factor in credit rating, insurance policies, and so forth. So if you're not managing your sustainability risk, it will eventually hit the bottom line. And this is exactly why regulators are stepping in. So frameworks like CSRD, CSDDD, EU taxonomy, CBAM, they are designed to ensure companies are assessing, disclosing, and mitigating these financial risks before they translate into a crisis. So whether you're still in scope, the rigid EU regulations, or possibly sit outside, the motivation to assess, disclose, and act on sustainability risks remain critical, not just for compliance, but long-term business resilience, financial stability, and overall competitive positioning. So with that, I'm going to hand over to Victoria, who will connect this bigger picture into the EU regulatory landscape.
Thank you, Helena. Helena highlighted the global challenges we are facing, and one way the EU is working towards a healthier environment is through the European Green Deal. So we wanted to give you an overview here of what the European Green Deal is. It is setting out the path for a green transition to align with the Paris Agreement. And it's the EU's overarching strategy to create a cleaner, healthier, and climate-neutral Europe. Why we need the Green Deal, Helena outlined it already from a global perspective. And of course, also the European future depends on a healthy planet. How is the Green Deal helping with this? So on the bottom left here, you can see a few of the main policies. There are many more smaller policies included as well, but you see here a few of the main ones. And what we want to talk about today is CSRD, CSDDD, the EU taxonomy, and CBAM. So all of those regulations that are proposed to be amended with the EU Omnibus proposal. You see some of the key goals broken down on the right-hand side into those 6 key goals of the European Green Deal. So it's climate neutrality, so a drastic reduction in greenhouse gas emissions for the EU to become the first climate neutral area in the world. You see circular economy, so a new economic model where products are reused, repaired, and recycled, reducing waste and conserving resources. Clean industry, so a push for a cleaner, more sustainable, and energy efficient industry which thrive in the EU and global markets. A healthier environment, plan to restore nature and work towards zero pollution to ensure a healthy environment for future generations. More sustainable farming means greener farming practices to protect the environment while providing healthy and affordable food. And last but not least, climate justice and fairness, a plan to make the transition fair and inclusive to help people most affected by the transition and leave no one behind. What we now see here is an overview of the 4 main regulations that we want to talk about today. CSRD, so the Corporate Sustainability Reporting Directive, that establishes a mandatory ESG reporting to enhance corporate transparency and accountability in sustainable efforts. One note here to the slide, you can see all the key requirements you see here are still valid even if the proposed omnibus proposal takes place as in the draft or in the proposal form as of now. However, a few details change. So, well, more than a few details, but a few details of those key requirements you can see here will change, and we dive deeper into them. What will stay for CSRD is clearly the double materiality assessment, the double materiality principle. When we look at CSDDD, what is CSDDD? It's a Corporate Sustainability Due Diligence Directive. So it's about looking at the supply chains of your company in regards to environment and human rights impacts. EU taxonomy. The EU taxonomy defines sustainable economic activities to guide investments and prevent greenwashing. So it covers those key objectives, 6 key objectives you can see here, and what companies disclose are disclosure of taxonomy aligned activities. When we look at CBAM, the 4th regulation we want to touch on today, CBAM imposes a carbon price on imports to prevent carbon leakage and align global producers with EU climate targets. CBAM requires importers to report on embedded emissions. And also here we will give you more details later on, but wanted to make sure that everyone's on the same page, what those directives are, what are the key points, and how, well, we see then how they will potentially develop with the EU Omnibus proposal. When we look at the timeline, what happened until today and how did the Omnibus proposal came around? In 2019 already, the European Green Deal has been announced, setting the goal of climate neutrality by 2050 and then influencing all the following policies. What we can see, first came the EU taxonomy regulation in June 2020 that has been formally adopted in June 2020. 2 years later, 2022, a political agreement was reached on CSRD, expanding the sustainability reporting requirements to around 50,000 companies. And then later that year, the final text of the CSRD was adopted by the EU Parliament and Council. 2023, the CBAM transition phase begins. There's a transition phase for 2 years, so until 2025, requiring importers to embed emissions in key carbon-intensive goods, but there are no financial obligations yet, so there's a transition phase. In 2024, there were heavy negotiations on CSDDD with an eventual final approval, however, with a reduced scope in companies. And when we look at a EU-wide EU-wide level again, we see, of course, that the Draghi report on EU competitiveness was published in September 2024, highlighting the EU regulatory barriers as one of the factors for EU's economic stagnation. Following that report, the EU Commission's President, Ursula von der Leyen, announced her intention to implement a far-reaching simplification on sustainability requirements, so the EU Omnibus proposal. There also has been some political movements. We highlighted here the German and the French one as the 2 biggest economies in the EU. So the German back then finance minister and also the chancellor publicly called to delay CSRD by 2 years and remove some of the requirements. France also urged a massive regulatory pause on new EU sustainability laws. So we also see huge political movement there. And then eventually, just 2 days ago, the EU Commission published the Omnibus regulation proposal. So the main topic of today, and we now get to it. First, a brief overview before we dive deeper into each of the areas. So when we look at the Omnibus proposal, we see 4 overarching themes. So we see the scope reduction, extended timelines, voluntary standards, and simplification. And without going too much into detail, you see, of course, that simplification is the main goal. That's the reason the Omnibus was proposed to support companies and reduce their reporting obligations. We can see that the companies in scope have been reduced for most drastically for the CSRD reporting, but also for the EU taxonomy regulation and CBAM. Timeline has been extended for CSRD and CSDDD, and there are voluntary standards for CSRD in the EU taxonomy. And now I'm handing over to Capucine for a deep dive on each of the regulations.
Thanks, Victoria. So we'll start with CSRD and how it evolves in the Omnibus proposal. We'll look at the current requirements and the proposed Omnibus requirements. Let's start with the numbers. Under the original CSRD framework, more than 50,000 companies were expected to be in scope. However, with the Omnibus adjustment, that number is significantly reduced to around 7,000 companies. This reduction primarily stems from the revised thresholds that redefines what constitutes a large company under CSRD. Previously, a company qualified as large if it had over 250 employees and met either a turnover threshold of 50 million turnover or a balance sheet of 25 million euros. Under the Omnibus regulation, the employee criteria has been raised, now requiring over 1,000 employees. Similarly, for the non-listed third country companies, the previous 150 million euro turnover threshold has been increased to 450 million euros, with entity-wide reporting requirements also being adjusted. The good news is, like Victoria mentioned, the fundamental principle of CSRD, which is the materiality, is supposed to be maintained. And when it comes to assurance, the original CSRD planned a phased approach from limited to reasonable assurance. The Omnibus regulation wants to keep the assurance to limited only to reduce costs for companies. A significant challenge for companies under CSRD has been obtaining sustainability data from across their supply chains. The initial requirements demanded that companies collect data from all suppliers where feasible, but the Omnibus regulation really eases this burden by actually limiting the requirements of information to companies to the voluntary SME standards that they plan to release. In terms of timeline, there's also a big shift. Originally, CSRD planned for large companies to start reporting in 2025, and the Omnibus regulation actually introduces a famous stop the clock to delay the reporting by 2 years, meaning large entities will not be required to report until later. The final change that we wanted to touch upon is the fact that the sector standards will be removed. So in summary, quite a big change in terms of the scope. CSRD is reduced by 80%. It is postponed by 2 years potentially, and the data requirements will be much more limited for small companies. Next, we'll look at CSDDD. For CSDDD, the change in terms of timeline is a bit similar to CSRD, with the fact that they actually want to shift the deadline of transposition to July 2028 instead of July 2027. However, the Commission commits that the guidelines, which were supposed to be released in July 2027, will be released 1 year earlier to support companies with that reporting. Value chain, as we mentioned, similar to CSRD, was also a very criticized topic in terms of complexity for companies in the CSDDD regulation. And so now the Omnibus wants to actually focus primarily on tier 1 suppliers or direct partners, unless there is a clear indication that the risks can happen beyond. In terms of the frequency of the assessment and the monitoring, Omnibus wants to extend the period to 5 years instead of annually to reduce the administrative burden for companies. In terms of relationship termination, there was quite a strict requirement from the current regulation to actually require companies to terminate relationships with their business relationships. And now it's actually been removed, and they want to encourage engagement over exclusion. Transition plan. So as you know, Omnibus, the whole goal is to align the requirements across regulations. And so they want to align the transition plan requirements with CSRD to ensure there's consistency. And that means that it would remove the implementation requirements related to transition plans. Data collection, similar to CSRD, the goal is to limit the amount of data to be collected to what's included in the voluntary standards of CSRD. There were some civil liability and penalties in the current requirements. Omnibus wants to remove both of those. And then finally, to ensure level playing fields across the EU on due diligence rules, the Omnibus actually calls for more harmonization. So big changes is the deadline shift, the focus on direct suppliers, and the fact that penalties and liabilities are removed. Next, we'll be looking at EU taxonomy. For taxonomy, as mentioned by Victoria in the trend slide that we covered, actually the first big change is that opt-in regime that they want to implement. The idea is that for companies under the future CSRD scope, those with more than 1,000 employees but less than 450 million turnover, claiming taxonomy alignment, that the reporting will now be voluntary. Omnibus also making the OPEX KPI voluntary. The Omnibus package also includes draft amendments for consultation to the Taxonomy Disclosures Delegated Act and the Climate and Environmental Delegated Acts. These proposals aim to simplify the reporting templates, reducing data points by almost 70%, and introducing a financial materiality threshold to make sure that companies can prioritize disclosures with significant economic impact. Now, companies that are making progress towards sustainability but only meet some of the EU taxonomy criteria can also voluntarily disclose their partial alignment. And this is all in the idea that Omnibus really wants to scale up transition finance, so allow companies to showcase their transition efforts while also receiving recognition for their commitments. When it comes to financial institutions, they are requesting an adjustment to key performance indicators, namely the green asset ratio, which would allow banks to exclude certain exposures from their green asset ratio calculation. Last but not least, the Commission is actually seeking feedback on 2 options to simplify the most complex do no significant harm criteria for pollution prevention and control related to chemicals. So big changes are the introduction of a voluntary and partial reporting, and also the simplification of the most complex do no significant harm criteria. And last but not least, we'll now move on to the CBAM changes. For CBAM, I think we can agree that the most significant update is the exemption for small importers, so primarily small and medium-sized enterprises. And the way they want to introduce that exemption is by adding a new cumulative annual threshold, which has been set at 50 tons of CBAM goods per importer. This means that actually 90% of all importers will no longer face CBAM obligations. That being said, the Commission claims that even without those in scopes, the CBAM would still cover 99% of the emissions. For those importers that remain under the CBAM scope, the proposed changes will simplify the rules and related reporting requirements, and they also plan to simplify the calculation of the embedded emissions. In addition to these simplifications, the changes will strengthen anti-circumvention rules, ensuring that the CBAM operates effectively in the long term and preventing any abuse of the system. And this is actually crucial because Europe is actually preparing for a future extension of the CBAM to cover other ETS sectors and downstream goods. A full review of the CBAM is planned for later this year, and if it would be accepted, the extension could be expected in early 2026. The Commission claims that these amendments reflect the insights gained during the transitional period that began in October 2023, and the biggest change is really the exemption for small importers and a simplified process. Now that we have a better understanding of the key changes brought by the Omnibus package to the 4 regulations that we just covered, it's important to note that the legal next steps are still to come, and it's still a proposal. So I'll pass it on to Victoria to go over those legal next steps.
Thank you, Capucine. Exactly. The Omnibus is still a proposal. So what happens next? The proposal will first go through a reading at the EU Parliament. The Commission has asked the Parliament to treat this with priority. The Parliament will then review and potentially amend the proposal and send it as a next step to the EU Council. And then the negotiations between those 3 different institutions will take place until a compromise is reached. Potentially, this process could take around 4 to 7 months is a number we often see and often hear. Until then, it's of course partly uncertain what is going to happen. A maximum after 6 months after the final vote, so there will be, after the negotiations, there will be a final vote in the EU Parliament on the then negotiated omnibus proposal. When this final vote is through, the ESRS standards will be adjusted and a substantial reduction in data points are expected for companies that are still in scope of reporting to CSRD. The final adjustments for the regulation will then need to be transposed into national laws of the member states. And the countries have 2 years for this transposition, 2 years' time. Large companies will then report in 2028 under the adjusted regulations instead of the previous plan 2026. And now with this outlook, I hand it over to Helena for the key recommended actions for companies.
Brilliant. Thanks, Victoria. So the biggest question we have is, as a company, what should you do next? First and foremost, action point is to stay informed. We keep saying, and I'll say one more time, it is just a proposal at this stage. Our feeling across Agendi is that we do expect it to pass, but of course that doesn't rule out any room for negotiation, potential revisions before final approval. While a full reversal is probably unlikely, these changes could still occur, and it may affect the scope, implementation timelines, or disclosure requirements. So a really big question for a company that was already preparing, potentially ready to report or already reporting, do you continue preparing under the existing regulations, or do you pause and wait? It's a very tricky answer. As a consultant, we would make this recommendation on a case-by-case basis. There's definitely a strong argument for finalizing your materiality assessment, and I'll go on to that in a moment because it does form the foundation of what are the material issues for your organization. But keep in mind the overall regulatory momentum remains strong. The direction of travel, as I said earlier, it's clear, and sustainability reporting in some form or another is here to stay. So moving on to step 2, and it's something we recommend, even with your trusted advisors or internal team, is to work closely with your legal compliance teams and ensure the necessary and correct interpretation. What you want to also be doing is collecting that necessary documentation, any calculations, whether or not you're in scope, out of scope, and you'll likely need those for the future as your organization continues to grow, things change. So do keep that in mind. And then we see 2 strategic paths coming down. We've got the still in scope and the no longer in scope. So if your company is still in scope, the priority should be to look forward to those modifications. Of course, we don't have all of the information now, but your priority is to revise, streamline your processes, and then reflect those updated requirements. And if you're no longer in scope, certainly no reason to abandon any ESG efforts. What we do know is that investors, stakeholders, supply chains, they're likely to still expect disclosures in some form or another to meet their own requirements. And so what we see is a focus shifting from compliance-driven reporting to strategic sustainability action. So I'm going to deep dive into these 2 areas on a subsequent slide as we move on. So if we focus narrowly on the companies that remain in scope, as I said, the priority is clear. You need to continue to refine your reporting processes, strengthen your ESG governance, and try to, as best as possible, integrate sustainability into your core business strategy. While some of the requirements are relaxed, the regulations do remain legally binding. And first, you want to ensure that you have a rigorous materiality assessment. So that's the foundation of all of the feed-on reporting. So if you have a robust, data-driven, evidence-backed materiality assessment, that will ensure your reporting only focuses on the truly material topics, and of course withstands the regulatory scrutiny that comes down the line. And it isn't just about compliance, your materiality assessment, it is your best strategic tool to limit your disclosure boundary. If we move on to data and reporting, as Victoria mentioned, look out for those ESRS data point revisions coming our way. Also continue to improve, streamline your data systems, governance, platforms, tools, solutions are all catching up. At Agendi, we stay abreast of all of the different platform tools and solutions. There's some really great products coming down the line. You will have a minor relief on the CSDDD transition plan implementation, but keep in mind that disclosure and adoption still remains via CSRD. And as we detailed in the opening slides, this is really about business risk mitigation. So we do recommend to keep going with your transition planning. Obviously, there's going to be some savings from due diligence of the transition planning. Potentially, that could open up opportunities to channel this into decarbonisation, further climate solutions. I'm sure it's already the case, but do stay friends with your auditors, engage early, and look out for those assurance requirements expected this spring. I'm sure your auditors are doing so anyway. And finally, if we think about the action for those companies still in scope, the aim is to maximize the utilization of your sustainability disclosures and try and integrate those across your business strategy. And so moving on, as a reminder, this is what a typical CSRD implementation process looks like. Of course, just focusing here on CSRD, but of course, Agendi, we support across the whole family or suite of regulations. If you're a company still in scope, and of course, if Omnibus passes as is, your focus will be to review your implementation phases and look at streamlined requirements and seek opportunities for optimization and additional value creation. These EU regulations are likely here for good, so do think about the future. For example, if you look towards your materiality assessment, how can you integrate that engagement on impacts, risks, opportunities into your everyday business activities and regular touch points of engagements with your stakeholders across the year? And equally, thinking about the future, how can you devise and adapt a scoring model to allow for simple interpretation and adjustments based on evidence to understand how your materiality changes from year to year? So do reach out if you'd like to set up a call and discuss how Agendi can support you. But I'll move on to companies who may have potentially fallen out of scope. As I said, if you're no longer in scope, this does not mean sustainability reporting should not be a priority. While regulatory obligations have eased, the business case for ESG remains as strong as ever. As I said earlier, you're going to have investors, customers, supply chain partners still demanding that transparency, and sustainability risk will remain a material financial risk. So what we see happening here, if you potentially fall out of scope, your focus will shift from compliance-heavy reporting to strategic, voluntary sustainability positioning. And I do put a little caveat here, because do watch out for regional, local regulations, particularly around climate-related financial disclosures, which of course we have here in the UK, California, France, etc. Your materiality assessment is still foundational, and we do recommend to continue to complete it because it will allow the efficient prioritization of your resources towards the most impactful ESG topics. So do finalize that assessment. Although with the audit burden lifted, you can potentially streamline that approach, streamline your scoring methodology. You're not tied to that FRAG methodology as tightly. If you're no longer subject to CSRD and family, this is your opportunity to align with leading voluntary frameworks. So ISSB, GRI, TCFD, CDP, the list goes on. And this will provide you with a consistent format of disclosure for your stakeholders. And moving on to data reporting, you can consider a lighter, potentially more strategic approach. You can prioritize the most relevant ESG metrics that align with investor stakeholder expectations. At this point, potentially, it also makes sense to consider whether or not assurance brings value to those stakeholders, and we would see that on a case-by-case basis. There exists a huge opportunity to redirect resources into tangible sustainability action, whether that's decarbonization, circular economy, biodiversity strategies, social programs. I could go on and on there. So whether or not you remain in scope or not, the message is the same, that sustainability is no longer just a regulatory issue, it's a business necessity. And of course, do remember that falling out of scope does not mean starting from scratch. ESRS was built on existing global standards, meaning any preparations to date provide you with a strong foundation to continue voluntary reporting. And falling out of scope allows you a moment to step back and review your sustainability reporting strategy. So I've got here a very high-level map of potentially how you may approach your sustainability reporting. It's no longer going to be strictly about compliance, although, as I said, watch out for other regulations. It's now about building a strategic, efficient, and integrated approach that adds real business value. At Agendi, we support organizations across the entire process on a voluntary perspective, looking out for various regulatory frameworks, looking at defining what are the material issues, selecting the best framework, supporting alignment, building out a roadmap for the future, and of course, assessing technology options. So once again, happy to set up a call. You will ping me at the end. And then how are we going for time? Great, we're speed on through. I'll run through the key takeaways and hopefully we'll have time for a couple of questions. I can see some rolling in. Key takeaways. As we said, first, the Omnibus proposal, it narrows the scope, it takes out 80% of the companies. We've got extended timelines, reporting requirements streamlined, but do keep in mind, the final legislation is not yet set in stone. Negotiations, they're still ongoing. Further refinements are possible. So stay informed, be ready to adapt, work with your legal teams, external counsel, etc. Once we have a decision made, for those still in scope, your focus is clear. Your materiality assessment remains crucial. Focus on your data governance, assurance processes, and look out for those ESRS data point updates. And your goal is to not only comply, but also make sure that those disclosures are used more widely to maximize business value. And for those no longer in scope, the expectation for sustainability transparency, as I've said a number of times, it is not going to go away. Your focus is to align with voluntary frameworks and potentially try and redirect any resources towards high impact sustainability actions, potentially decarbonisation, etc. And finally, sustainability remains a business necessity. There's some regulatory relief, but strong sustainability reporting is going to be essential for your risk management, investor confidence, long-term resilience. Brilliant. So with that, I think we've got about 4 minutes left. We can move on to the Q&A. Thank you so much for attending. As we said, we'll be sending out the recording. Any questions that we don't get to in this very rapid Q&A piece, we're more than happy to connect individually and send out. So perhaps maybe Capucine, I'll hand over to you to moderate the questions.
Thank you, Helena. I'll go and have a look now and select a few because, like Helena mentioned, we have 4 minutes. But so from the questions that were previously sent before the webinar, maybe one for you, Victoria, is should we halt our CSRD reporting preparations until the omnibus changes are finalized?
Thank you, Capucine. I can take that. I think it's a great question. The short answer would be no, don't completely halt of your situation if you will be in scope, but later, or if you will be falling out of scope. It really depends where you are in, for example, your double materiality assessment preparation for CSRD. And also, of course, as we mentioned before, we can't forget this is a proposal. It can take up to around 7 months or maybe even longer until we see finalized regulations. This is a very long time that you could use to further prepare. So we do recommend prioritization and maybe not investing in all areas that will be likely to be cut. But continue building your reporting processes for your core ESG topics. So you are prepared if the omnibus is taking place like announced or in a reduced capacity. But happy to discuss further on a case-by-case basis.
Thank you. Then there was another one. Although we don't have a crystal ball, it says, how likely are these proposals to pass as is? Could they be blocked or significantly changed?
Yeah, I think that's a good point. And of course, it's very speculative here. What we see is definitely a big call for simplification from the Commission and from the member states. I talked previously about the pushes from Germany and France, the two biggest economies in the EU, towards simplification, towards a lower burden for companies. I think we can see a global shift for reduced regulation and reduced bureaucratic burdens for companies in general. So, of course, not 100% sure or clear here if the omnibus will pass in this capacity, in this proposal draft. However, that something in the massive simplification will pass is quite certain.
Thank you. I think we are at time, so maybe Helena, if you want to share just a closing word before we close this webinar.
Brilliant. I don't think there's much to say. Can see some really great questions that we definitely don't have time to go into, but maybe I could just touch on that last one that's popped up in terms of the DMA requirements. You know, what we see is that a double materiality assessment is still expected. There's a lot of schools of thought that essentially say that although you can focus on financial materiality, one of the aspects of CSRD is taking that high time horizon far out into the future. And if we take out that time horizons, what we're going to see is that any impact-driven topics are likely to have a financial or an opportunity impact on the business itself. So whether it's double or single, what is really important at times often is that time horizon. But I'm getting nudges. We're out of time. Thank you so much for joining us. A really wonderful turnout. We will get to all of those follow-up questions. We'll be sharing the recording, and many thanks for your participation. Thank you so much.